The other top rule back at the ranch that we want to continue with is the whole point about swing trading. We're only looking at small rises over small periods of time, therefore enter quickly. If you've missed it, you've missed it. Don't try and chase the market. If you've waited too long and you think you're getting in too late, then leave it. There'll be another opportunity long later. Let's say it's a curve like this. Remember from one of the earlier chapters, we don't want to get in at point Y, we're trying to get in at point X. If we've missed it and we've missed the opportunity, we're wasting our time, we might as well focus on better entry points somewhere else later on instead. That's my take on it. Moving to another rule. And part of this is what I mean is, if you've got something like this and you've got a downward trend, now you could argue, and let's say you missed this big rise here, you could argue, well, you know what, I've still got the opportunity because I could get in here and so forth, even if I missed getting in on the break of the uptrend around here. And it's not much of a difference between the two. It's a difference between 300 and 285. And indeed, in hindsight, in this example, you can see how it continued and went on and upwards and so forth. Don't be fooled. Don't think just because sometimes that happens and there's an opportunity to get in early that you should do that every other time. The reason for that is if you did get in at this point, instead of getting in somewhere on a breach of the downward trend line, maybe intraday, somewhere closer to here, the danger is you get in and the price, instead of doing what it's done, does this. Well, that means on a case like this, whereas instead of you might have got out without making a loss, here you make a significant loss. And you need to avoid making those kinds of losses because there'll be enough of these types of trades where that does indeed happen. And we've got to focus on the downside, and that's why we don't let these types fool us into getting in even though we're late, on the basis that even if you're late you can still have opportunities. In actual fact, there's always opportunities along the way, and we mustn't fear waiting. The next point I want to get on to is one about pyramiding. On the whole, don't pyramid. That means when you add to a position. People particularly do it when they're losing in a trade. When they're losing, they add more to the position to reduce the average trading price, trade entry price, so that the break-even point is reduced. So the price only needs to move a smaller amount for them to break even. On the whole, you certainly shouldn't pyramid if the price is falling, i.e. going in the opposite direction to your trade. You shouldn't pyramid in order to get a lower entry price. You shouldn't pyramid to get a lower break entry and a break-even point. The only time you do it is when you haven't entered your full position, are waiting for price confirmation, the price has moved in the direction of your trade as opposed to moving against you, and so you enter into the rest of the position. So let's say you entered some of it here and you're going long, you then, as the price actually does start indeed moving and going correctly as you predicted, get into more of it and close out the full position. I'm not saying you become undiversified by doubling a position in one particular thing compared to other stocks. What I'm saying is at this point, at the entry point, you might only have opened, say, half your typical size, wait for price confirmation before opening the rest. Now that's very different to doing this, where let's say you've entered, and instead of the price rising, it falls, and so what you do is you end up buying even more. This is where you're looking to go long. You buy even more as it's falling in order to reduce your entry price from being here, at this point, to being a bit further down there. On the whole, do not pyramid.